What's up, y'all? C-Type Nabuya, multifamily expert. Today we're delving into a critical aspect of commercial real estate, the financing. Commercial real estate is very much a capital business. It doesn't matter how well you can find a property or how well you can operate a property if you can't actually afford to get the property. So whether you're an investor, developer, or whatever you're trying to do, it's very important that you understand all the different finance options at your disposal and then how to actually structure them into a deal to be able to scale and be able to close deals. In this video, I'll cover several common financial options. I'll talk about what they are, and then I'll also discuss some pros and cons to each of those. So let's get started. Before we get into the different financing options, it's important to understand what a capital stack is. It is incredibly rare for a commercial real estate transaction to be paid with 100% cash. Usually it's going to be at least 2 to 3, sometimes 4 or 5 plus funding sources. So a capital stack just refers to how those different funding sources are layered on top of each other. And it's a stack because there's a particular order that has to be followed. So in the event that the property is sold or the property is foreclosed and it's sold and the sales price just isn't enough to cover the initial value and pay all the funding sources back, the order of the capital stack will determine who gets paid first, who gets paid second, so on and so forth until the funds run out. So the funds on the bottom of the stack are the most secure and the funds on the top are going to be the most risky. First, let's talk about debt. So debt refers to a loan or a mortgage, of course. Now this typically will account for about 65 to 75% of the purchase price. Now debt is a contractual obligation to pay the loan back on predetermined terms. It does not grant the debt provider ownership of any kind. If the property fails to perform based on initial projections, the debt obligation does not change. That means it's a little less risky. If the value of the property increases beyond what was projected, then the lender does not get to participate in the upside. So debt is seen as lower risk, but also lower reward because you can't really participate in the upside if it's a home run deal. Now there are going to be two main types of debt in the commercial world. The first is going to be agency. The second is going to be bridge. Now let's talk about agency. So agency debt is provided by one of the major government agencies such as Fannie Mae or Freddie Mac. Agency debt has more stringent requirements and is typically used for stabilized properties that are well occupied already. Agency loans usually have longer terms, so 5, 7, 10-year terms, and they tend to have a steep prepayment penalty that keeps you from exiting the loan before the term is over, and that's when it matures, as they call it. The other main type of debt is going to be bridge debt. So bridge debt is often used for projects that need a quick infusion of capital or may not initially qualify for long-term agency financing. So it may be a distressed property or it's a value add scenario where you need capital to be able to improve a property and then stabilize it. So bridge loans typically have shorter terms, between 18 to 36 months, and they often don't have a prepayment penalty for paying off the loan early. A common strategy when acquiring a property is to use bridge debt to acquire the property, spend 18 to 24 months or so to stabilize the property, and then you refinance into longer term agency debt. Now let's talk about mezzanine debt. Mezzanine debt is a supplemental loan that fills the gap where you can't secure enough financing with just a senior loan, with just agency debt or bridge debt. The term mezzanine refers to a floor in a building that sits between two different floors. In finance, mezzanine debt is a loan that will usually sit in the capital stack between senior debt and equity. Meaning, in the case of foreclosure, the senior debt gets paid first, the mezzanine loan gets paid next, and then the equity is in third position. So it's behind both of those loans, both the senior loan and the mezzanine loan. Now let's talk about equity. Equity refers to the ownership interest an investor has in the asset. Equity has no guarantee of return. If the property performs below expectations, an investor's equity investment can be completely lost. On the flip side, if a property outperforms projections, the equity value rises with the property value. So if you would hit a home run deal as an equity investor, you get to participate in that upside. So equity is higher risk and higher reward than debt, and equity is often how people in the business world get rich. Let's discuss some different sources for equity. GP equity is equity from the operators, the general partners. So if you're the investor that you're doing the deal, this is your financial contribution. Sometimes it may be the only equity in the deal if you didn't really bring in any partners or any type of private equity or anything like that. Next is going to be joint venture. So a joint venture, abbreviated JV, is when two or more investors will partner together and pool their funds to bring the equity needed to close a deal. And this is on just a single particular deal, so these are not actual business partners, it's just for this deal. So JV is a common strategy when the equity required is a little too large for a single operator, but not so large that you really need to bring in a lot of other equity partners. Next is going to be syndication. So this is capital raised from limited partners, LPs, who have no active role in the deal. So LPs just invest passively, and these may be high net worth individuals or high earning individuals who just want a return on their money without having to do the work associated with operating real estate. So typically their return is going to be prioritized in a preferred return, meaning the operators or the GPs won't take a cut of any of the cash flow until the passive investors are able to meet their returns. So LPs typically have a specific time horizon with their investment, which is typically about 3 to 5 years. Next is going to be private equity. So this is capital sourced from private equity firms who pool capital together from various high net worth individuals and institutions. Typically, they have a minimum amount that's going to be higher than what the average multifamily or commercial real estate investor will need for their deals. So it's usually for larger deals or larger projects. In contrast to syndication, where you have several investors investing into the fund alongside each other, a private equity firm will typically put in a huge chunk, usually around 90% of the equity needed for a deal. And then the general partnership is responsible for that remaining 10% of the equity. So general partners may syndicate this remaining 10%, which will further reduce their capital contribution needed. PE firms often want control over a deal in some regard, and they can force you to exit as an operator before you're ready. So you just got to keep that in mind. You're giving up some control if you go to a PE firm. And they'll typically have a time horizon of maybe like 3 to 7 years, so maybe a little longer than syndication. Next, and often used for very large checks, is going to be family offices. So they're similar to private equity firms, but will invest capital of one or a few ultra wealthy families, like very rich families. And they'll typically have a longer time horizon that may stay in the asset across generations. So family offices manage the capital of people who aren't looking to get rich because they're already super wealthy. So they're looking for more stable, patient returns as opposed to the home run, high risk type deal. Lastly, we have mission-based equity. So if you're in the space of community development or affordable housing, you can use mission-based equity firms to fund deals. So these firms may have lower return expectations or just may be more flexible in how you do your distributions to them because they care more about the community development aspect as opposed to just purely be trying to make money or return on their investment. So that's it for the equity. Now let's discuss some other less common financing options. But before we do that, if you got some value out of this video so far, please go ahead and like and subscribe for more content that's going to be coming. First of the alternative funding sources is going to be seller financing. This is when the seller acts as the bank. So instead of getting a loan and paying the bank back every month, you pay the seller every month at an agreed interest rate. So this saves you from having to get a new loan, and you can be a lot more flexible in your negotiations with the seller than you could with the bank. So you can get better terms often. So this flexibility often allows the seller to get a better price for their deal than if you would have had to go and get new debt, because usually you can get just better returns or better terms. Next is going to be loan assumption. So that's when you take over the existing loan on the property instead of securing new debt. If there's a loan already on the property with better rates than what you can get out in the market already, then it can be advantageous for you to assume this debt and just take over the payments as opposed to just trying to go and get a new loan. It's very common in today's high interest rate market. Another source is going to be grant funding. So these are going to be state, federal grants to support some community need. So it may be like affordable housing, job creation, workforce development, economic development, a whole bunch of different things. So grants are ideal funding because they don't need to be paid back at all. So it's essentially like just free money. Caveat though is that it can be a bit of a process, so it's a lot of effort often when you're trying to do a grant application. And then the requirements, a lot of times it's going to make most for-profit projects ineligible. And then the timeline. So grants take a very long time to fund, which can be preventatively slow for your deal. You can find grants from housing authorities, nonprofits, state agencies, and then there's sites such as GrantWatch or grants.gov where you can look and see what's available for you to apply for. Another more painful source of funds is going to be tax credits. First is the low income housing tax credit, abbreviated LIHTC, LIHTC. And these tax credits support the creation and preservation of low income housing with rent restrictions. Then there's also the new markets tax credit. So local governments use this as an incentive to develop in a certain area that would otherwise go without development. And that's typically because the area just doesn't have the economic viability for a private investor to want to put funds into it. Either way, the tax credits are going to be awarded to the developer, which then will sell the tax credits to a financial institution in exchange for capital that will ultimately subsidize the project. Lastly, we have TIFs or TADs. So TIF is short for tax incremental financing, and TAD is short for tax allocation district. So they're called TADs in Georgia because Georgia wants to be different, and everywhere else it's called a TIF. Either way, they're the same thing. And it's a financial tool used to stimulate an economically depressed area. So basically, the government projects the tax revenue that will be created by whatever particular development is proposed. And then they will use those future revenues from the taxes that haven't happened yet. And they will use those to earmark funds that can be used to subsidize the development now. So essentially like taking money from future tax revenue, using it to fund that project that's going to create that revenue. In conclusion, there's a lot of different ways to finance a commercial deal. Learning where to get funds and how to structure deals efficiently with all these different resources is crucial to being able to get deals funded, get deals closed, and ultimately build a portfolio. If you like this video, please like and subscribe for more content. I'll be breaking down stuff just like this. If there's any funding sources that I missed, please let me know in the comments. And as always, appreciate you for tuning in, and we'll see you next time. Peace.